Good afternoon, everyone. My name is Aparna Manchanda. I'll give a quick introduction before I start. I have 20 plus years of experience in predictive analytics and predictive modeling, data analytics, data science. It spans marketing analytics, credit risk analytics, and risk and regulatory analytics like Basel III, FIRS 9. Uh, I've been associated with my company, DMI Finance Private Limited, for 9 plus years now. I was the first member to join the team. I was the first one to look at their data, write codes, create models. And it has been a very rewarding journey over the years where I've structured and grown the team, alongside the business of my company. I'll take a quick few minutes to describe what my company does. So we were one of the first few companies in India to kind of create a completely automated lending journey. So what I mean by that is, the credit adjudication decision where a customer applies for a loan up to the disbursement of the loan is completely digitized. There is no manual intervention whatsoever. So, we work with some of the bigger names, all over the world. So Samsung Electronics has a program where, we essentially provide the customer, creates the application virtually. It takes a quick few minutes, and we give out the loan decision in a few seconds. So we were the first one to start this in India with Samsung. We work with other big names like there's a wallet. There's a wallet from Google called Google Pay. We work with many names like this. So today I'm going to talk about one of the case. In more detail about the work that we do and how, we've actually bought digitization in the lending journey and how we've actually made it work and be very profitable. So, this essentially captures a lot of what we do, but there are a lot of details hiding in the bigger part of the slide. So I'll start from the rightmost part a bit. When a lender actually looks at a credit adjudication decision, what they're thinking about is two things. The borrower's ability to repay, as in does the, if I give a loan of X $100, will the borrower be able to repay that amount? Even if he has like the intention of repaying, but will he have the financial capacity to service that loan? And of course, will the borrower even have the intention to repay? So these are the two main axes along which, we decide. Obviously, there are ancillary things like fraud, risk, etc., which I'll come to. But the two main axes for the lending decision are these. So, coming to the ability to give the loan, we essentially we try to assess the income or the cash flow strength of the borrower. So, we get an income prediction, and from there on, we actually assess also what the borrower is repaying to other lenders. So there's a concept of a fixed income and obligation ratio, basis which we decide, okay, this is the maximum EMI that the borrower can service, and basis that maximum EMI, what is the highest loan amount that we can actually approve for the borrower. We also, talk about the willingness to repay the loan. Does the customer, actually intend to repay? Looking at data like of all the past 4 or 5 loans that the customer has taken, does he repay regularly? What's his bank statement like? What's his inflow? What's his outflow? Etc. So, a lot of assessment is done to see if the borrower will actually intend to repay the loan that we give to them or not. So, and of course, if there is a repeat borrower, a customer has already taken a loan from us, some other loan, maybe a consumer durable, now he's applying for a personal loan, we actually also look at the repayment history and the repayment track that the borrower has maintained on the other loan with us. So I'll quickly talk about these data sources that we see here and how we utilize these in the credit adjudication decision journey. So one of the very important and critical data sets we all know for all financial modelers, it's the credit bureau data. We are all familiar, beyond just the credit score, there's a lot that, really is available in that data. So we have about, 2,500 features library that gets created. So, we look at aspects like, how many loans the customer has not repaid properly in the past, how far his last delinquency in the past was, how much is the customer very high vintage, has he been tapping the financial system for long, has he maintained a good track record, not just of payments, what is his track record on his credit cards, whether customers revolve or, are they transactors. So, these are the starter features, but we get into a lot more complicated things like, is the borrower just revolving credit, which is essentially he's taking more loans to repay his past loans. So, a lot of, business insight has been, utilized to kind of create the library for the models that we develop. Similarly, for bank statement being a direct, representation of, the way a customer is, his financials. It's very, very illuminating about not just his income directly and indirectly, but also about his willingness to repay the loans. So essentially, if the customer is like, if the customer is bouncing installments of other loans, we know he is very risky, right? And there are many small indicators which turn out to be very powerful. Things like, if the customer... if the customer is using a bank statement for many debit transactions of varied amounts, very logically, the bank statement that the customer has given to us is of an account he uses regularly. It's his bread and butter account. However, if the customer has given us a statement which has in 6 months, let's say some 12 transactions, a few debits, a few credits, we actually know that the customer is not disclosing his very real financial status to us. So what I mean to say is that we create a very, very holistic view. Some things are very obvious that we create from the statements, but we delve down deep. So, and the repayment history of borrowers is pretty straightforward. Other sources that we use, the demographics of the borrower, very powerful again, education, we can't use, things like race, gender, etc., but things like the education history of the borrower, is it a rented dwelling or a cell-phone dwelling that he lives in? These things are pretty powerful indicators. We use a little bit of device data as well. Of course, that's contingent on getting the explicit consent of the borrower and what is allowed by the regulator. Things like, the geolocation from where the borrower is applying for the loan. And we can actually, extrapolate a lot more from that small signal also. We could go to bigger things like if the borrower is not applying from his home, not applying from his office, from, for which we have the addresses, and the borrower, likely, again, maybe wants to hide something, not necessarily, but that's like a important signal. Beyond, this is, our structure of our core decisioning engine. We have the models which give the outputs. We have algorithms and rules as to how we want to combine these. and give out a completely automated lending decision. Uh, and a few aspects of the work we do, of course, we use the linear logistic, all the generalized linear regression techniques. Aside from that, we use the machine learning techniques, XGBoost, random forest, etc. We do end up using a fair bit of natural language programming in our work as well. I mean, even if you consider structured data sources like bank statement, there is a description field which is not very standardized. It will have abbreviations, it will have text, it will have numbers. And the machine, by using NLP techniques, the machine itself is able to classify a transaction. The machine, the algorithm can tell us what really was happening in that transaction, which helps us better understand the bank statement of the borrower. So and aside from that, we use enrich our conventional data sources, which I've talked about, by a lot of alternate data that we can fetch. One simple example is geospatial data. So, what I mean by geospatial data is we have the borrower's address, and typically in India, and I know many other countries, there are a lot of vendors that, divide the entire geography into 1 square or 5 square kilometer tiles. We have attributes about that whole tile available, things like, what is the working population percentage in that particular geography, how many restaurants are there, what is the road network like. So essentially we can, from even geographical data, we can understand what's the affluence of a customer, is he living in a very serviceable area, he's not very remote, etc. So that's, our core decisioning engine. So I'll move to the next slide. Yeah. So, this slide basically talks about the kind of results that we've been able to achieve. However, before I start talking about the results, I outline the approach and, the way we are using our solutions to essentially approach the decisioning problem. But in my experience, I've found that there are two situations in which this kind of a decisioning engine works very well. One, if we have a lot of high volume of transactions. So, when the volume of transactions coming into a lender to assess is low, it's feasible to have, it's very feasible to have, manual intervention in the loan journey, manual credit adjudication experts looking at the application, understanding it. But when the volume is very high, this kind of a setup becomes very, very feasible. And the second thing, the second criteria is that the ticket size or the volume of the loan amount that we're trying to disburse is low. So I wouldn't typically recommend a completely automated journey for a product like a mortgage loan. But, if it's, let's say, a $500 personal loan, even $1,000 personal loan, it's like this kind of a solution is more viable, more profitable. So yeah, I'll show one example, of how we approach the whole setup of the models and getting the data, etc. And we have replicated this across our, lending partners. So, most of us who are familiar with creation of risk models, they would know that what we try to do is either we try to increase the volume of the applications, the volume of the loans that we are disbursing, keeping the default rate or the rate of the borrowers who are not repaying, or the NPA, non-performing asset rate, under check. So we we utilize models to help us find better and better customers so we can disburse more, but that without pushing up the default rate. The other way to utilize lending models is you can keep the volume of the applications by and large same, but you can really decrease the default rate that you're incurring, or the NPA, the non-performing assets that you're accumulating on your book. So what we've tried to do, we do here is, if you see the initial part of the graph, we are essentially just understanding, we are disbursing a small volume, we are collecting data to get good models. We are, understanding the risk of the portfolio, the customer dynamics, and then as we move on, we've maintained a very steady default rate, which is on the two lines, and we've substantially increased the business that we are doing. And of course, by this point, we have a lot of data. We have very stable, very robust, very mature models. We've significantly increased the volume. And, along with it, we've kept the bad rate largely in check. On the calendar axis, you'll see the last 1.5 year is not there, but that's because, we can only look at the loans that were disbursed till some time back, because, they will take an year or so for the default outcome or the repayment outcome to be actually witnessed. So, this just looks like a graph, but, understanding the risk, creating the models, refining them, attuning them, more to the business, it has been a very, I would say, scary, intimidating ride, plus, a very rewarding one. I mean, there are times when I've had severe anxiety over, oh my God, will this deployment work? Will we get some hitches? The way we are looking at the customers, I hope that the NPA doesn't shoot, and a lot of stuff. But as I said, this journey has been really rewarding. And just a few more things that I'd like to say beyond this graph. While I've kind of painted the whole income and default rate picture, there are a lot of ancillary things that go on to refine that lending decision, which me and my team, we also create. There are things like fraud risk. It's relatively minor, but a very pertinent thing to look out for. And it's more challenging than doing this because, fraudsters are very smart. They're continuously evolving. And aside from that, we have things which we call services or solutions. So, we have things like the address quality of a customer. The customer gives a present or mailing address, a permanent address. We have like whatever is the document that the customer gives to verify himself. We have that address. Bureaus report address, bank statements have addresses. So we actually put all of them together to see, does the customer have a stable address profile? Looks small, but many fraudsters are caught by using this service. So, aside from, the key models, we develop a lot of ancillary models, right? So, we also have a solution which uses macroeconomic data. So, the models that I'm talking about right now, they look at the borrower pool at one given point of time. Right? Like if I acquire a borrower with these characteristics, will the borrower default or not? But what we have to be very mindful about is that, if the macroeconomic situation changes remarkably, then, the whole outcome might change. The same borrower or many borrowers, more borrowers face financial crunch, defaults are higher. So what we essentially do is we look at the portfolio as a whole, at multiple points of time in the past, what were the default rate of my entire portfolio of its segments, and essentially what was the macroeconomic situation, the unemployment rate, the GDP growth, exchange reserves, many factors. Aside from it, we also look at how our portfolio has behaved at at those times. So essentially, things like maybe the growth rate of loans when times were benign versus when times were not so good. So looking at all these features, we have a solution which actually incorporates macroeconomic data and refines these predictions to reflect the situation of the economy as well. So yeah, that's largely the work we do and what I wanted to talk about. Thank you.
Can you give a bit more detail on the NPL analysis and how that is incorporated into with other model outputs, incorporated into the final decisions?
Oh, so by the NPA analysis, you're saying the macroeconomic data, how that's incorporated, is it? Oh, the text. Okay, sorry. Yeah, so again, as like one of the examples I gave is very obvious, bank statement descriptions. So there, essentially what we do is the bank statement description is not really standardized, right? It's difficult to read from that whole, a combination of abbreviation. Oh, I'm sorry. Okay, so it's difficult to read from the whole combination of abbreviations, words, numbers. What really is happening in that transaction? Is it a debit transaction where the customer is using his debit card at a point of sale or, at a merchant outlet? Or is that really a customer paying his installment for another loan? So we use a lot of machine and deep learning techniques to kind of distill, meaning out of that whole text.
So if I understand correctly, so basically you use the NPL to analyze the statement and classify that type of classment.
Yes.
The statement, and use that as the input to your models?
Yes, because that then refines our model a lot rather than just saying, okay, these are the debits, these are the credits, this is the consistency with which they happen. We can actually do a much richer assessment of the bank statement, right? Because the examples I gave now, we can see things like, okay, this customer has bounced on an installment payment of another loan vis-a-vis, okay, this customer has given me a very small statement, or this customer is just shuffling money around his own accounts, not doing much else, right? So all that becomes very easy when we distill meaning out of the statement transaction descriptions.
Okay, thank you.
Yes.
There is one last question. Okay, go ahead.
So how do you eliminate biases from the model when you're using demographic and geospatial data?
The question was how you eliminate biases when you're using demographics, right?
Demographic and geospatial.
And geospace.
So could you elaborate on the exact biases that you're talking about?
Biases, so for instance, someone is living in a certain area.
Yeah. Versus someone who's renting in a certain area. Yeah.
Deny a loan because of
So, essentially, I think the very natural way of tackling this is not to give too much importance to one, part of the data, right? Because, yes, the customer may not be living in a great area, but at the same time, the bank statement of the customer might be very strong, or the bureau footprint might be very strong. So that is something which is easily handled by looking. So that's why I spoke about the feature pool in the earlier part of the presentation, because if you're actually exposing the model to very comprehensive set of features, right? You're creating insight about more and more facets of his financial situation, his lending behavior, then you're not really allowing a lot of bias from one aspect to creep in. Sure. No, so we actually do a very thorough assessment also of the model outputs. Yes, we do a comprehensive range of tests. Discriminatory power of the model, the accuracy of the model, the stability of the model, and bias. Its sensitivity to some of the features. As I said, we expose the model to many facets so that the model is not extremely dependent about some aspects or the other. So yeah, we do a comprehensive testing.
You go.
Yes. Thank you very much. Thank you for your talk. Please, a round of applause for Pamela. Thank you so much.
Thank you. Can I just keep it there? Or? Thank you.
Okay, so we are now set to go to tracks 1 or 2 for the second sessions of the tracks. So please make your way to the rooms, whichever one is more interesting to you, and I'll see you there. Thank you.
So in track 1, we have data governance, operationalizing governance for innovation and impact, turning guardrails into growth. By Raymond Onami, Director, Data Governor in Syncor. And in the track 2, we have Using Generative AI in Fraud Analytics by Shamindra Peiris, Senior Product Manager in Visa. So if you want to listen about governance, this is the room. And if you want to listen about fraud, then you go to the track 2 with our friend Dalia.
With me. All right, see you.
Okay. I think that our speaker is ready. So please welcome. Oh, yeah, don't take this. Come. So, yeah, please welcome Raymond Onami, Director of Governance at Syncor. Thank you.
Cool.
Welcome.
Thank you.
Welcome.
So many years ago, I applied for a role of Director of Data Governance at a large Canadian retail corporation that will go unnamed. I knew the competition would be tough, strong candidates, impressive resumes, great experience, so I wanted a way to stand out and to make sure that they remembered me, something about who I am and what I stand for. So before the interview, I decided to go buy a soccer ball. The day came, I arrived in the lobby with my portfolio in one hand and the soccer ball in the other, and the hiring manager came down from the lobby, took me up to the conference room, and led me there where I discovered that the Chief Information Officer for North American Operations was going to be part of the hiring panel. It's not exactly what I expected, but the soccer ball came with me anyway, so I sat down and put it right on the center of the table. So we went through the standard and usual introductions and those questions, and as we talked, I noticed the CIO and the hiring manager kind of glancing at the ball every so often. So after a few minutes, I took my chance. I took my opportunity. I said this. So you're probably wondering why I brought this soccer ball. So then I explained. If a customer comes to your website or goes to one of your stores looking for a football, what they get back depends entirely on how your product data is defined. If the system treats this, a spherical black and white ball, as a football, but the customer is expecting this, the brown oval-shaped North American football, you've just created confusion. An associate might confidently bring the wrong product, the customer might push back, maybe it becomes an argument, and because it's football, it could get really ugly. Maybe they leave annoyed, deciding to shop elsewhere where someone understands what a real football is. That's what data governance is all about. I looked at them and silence. I think I just blew their minds away. I'm Raymond Donami. I'm the Director of Data Governance at SimCorp. SimCorp is a Canadian company established by our three shareholder banks, RBC, BMO, and TD, with the goal of creating this shared entity to modernize and streamline their middle office operations. And through this partnership, SimCorp has delivered critical services such as payment processing, customer communications, and financial fraud detection. We serve a wide range of clients from insurance, financial services, education, utilities, and all three levels of government. And today, we're at the forefront of one of the most exciting transformations in the financial industry, open banking. Open banking has already gained momentum around the world, and now Canada is joining that movement. And being in the position where we can help enable the secure sharing of financial data across this ecosystem, it's exciting, places SimCorp right at the leading edge of this new era. And so my goal for the next few minutes is to share 3 practical approaches we've used to build a strong, positive, impactful perception of the data governance function. So let's start with the first one, relationships. When people talk about data governance, the conversation usually jumps straight to policies, metadata, lineage. But the truth is, the most sophisticated data catalog in the world is useless if the person who needs to use it doesn't trust the person who built it. And what I've learned is that the real secret sauce of a high-performing governance function isn't just technical expertise, it's people skills. You have to understand your stakeholders as human beings, what keeps them up at night, what frustrations cause them to want to whip their laptop out the window, and what goals they're chasing this quarter. If they don't trust you, they won't trust the standards you're trying to implement. Your policies will look like red tape, not guardrails. And this starts with your own team. Applies, actually, everybody here. So when I hire, I look for 3 non-negotiables: smart, nice, and curious. Smart, not just about IQ or knowing SQL, I mean contextual intelligence. The ability to see the why behind the data. It's being able to translate complex requirements into clear business value, the way to think 2 to 3 steps ahead. Nice. Kindness matters. Small things matter. It's like sending that cat emoji to lighten a coworker's busy Tuesday. It's remembering work anniversaries. Being nice builds psychological safety, and that is essential for collaboration. Curious. Curiosity means listening more than talking. My wife tells me God gave you 2 ears and 1 mouth, so you listen twice as much as you talk. It's the instinct to ask why until you fully understand the root cause instead of jumping to conclusions or band-aid solutions. But at the end of the day, we don't just manage data, we partner with the people who create it, who use it, who make decisions on it every day. And that work requires a foundation of trust, the most important asset in any governance practice. If I get the opportunity, I'd love to share with you this theory I have around the economics of data trust. Maybe next time. But I've connected with their sales team. They're the fun ones. They have a gong symbol that resonates through the entire floor. Back in the summertime, I had lunch with one of their managers, Kelsey, and I found out her best friend wrote a children's book. She's a yoga instructor. She's watched the F1 movie multiple times, and she refers to AI with the pronoun he. Enterprise risk management, not a typical interesting team, but I've had so many Starbucks with Tom. I found out about his life as a Kung Fu instructor, his journey going from an accounting background into enterprise risk, and how many times he's been to Japan more than me. But the point is that all of us here as leaders, we need to model this and take the time to get to know people on a different level, on a human level. We're all on the same team. We all have lives outside of work. Not everybody opens up, but you won't know until you just reach out and build those connections. The reason why we prioritize relationship is because we operate in a federated model. And in this federated world, authority is distributed. I don't own the data, the business domains do. Most federated models don't fail because the strategy is wrong. They fail because the trust pipes get clogged. If trust isn't flowing from your data governance office to your domains, and more importantly, between those domains, the entire system slows down. Connections and trust are the social currency that make federation possible. Without trust, domains become silos, and governance starts to feel like an outside intrusion instead of a shared advantage. But when trust is the foundation, here's how it transforms governance into a source of innovation. Velocity through autonomy. In a high-trust federated model, you don't need to micromanage every data decision. We trust the domains to follow the spirit of the standards. They have the authority to move fast, experiment, innovate in their space. The data contract mindset, innovation only happens when data moves seamlessly across the organization. For example, marketing needs sales data, who needs finance data, who needs operations data, it flows. That exchange requires trust. One domain must trust that the other is maintaining the quality of the data that they're handing over. Reducing defensive data behaviors. When trust is missing, domains hoard data, or they quietly clean to hide the flaws. When trust flows, people feel safe about being honest about their gaps. And that honesty allows us to fix root causes together, clearing the path for reliable enterprise-wide insights. And from policing to partnership, trust shifts from the central team's role from enforcer to accelerator. Instead of asking, will I get in trouble for this? Are you just going to slow me down? The domains start asking, how can you help me do this faster? Your technical architecture is only as strong as your human architecture. So once you build the relationships, you have to earn the right to stay in the room. And you do that through relevance. Data governance often fails because we speak data ease, schemas, master data, lineage, but the business speaks in outcomes. And to become a true enabler, we have to learn their language and their way of working. Building a bridge between a data foundation and a business goal, that's more of an art. And our job is to translate these rigid data principles into something usable, usually negotiable, because every team is at a different level of data maturity. We don't push or pull the business. They already have enough pressure from the market and from the C-suite. Instead, we walk alongside them, not as a barrier to creativity, but as a wind at their back. There's a quick story. So I remember being in the room with sales and marketing team to talk about lead generation, and within 5 minutes, I realized I was in a foreign country without a map. To me, SQL means structured query language. And to marketing, SQL is a sales qualified lead. So when I asked about the status of their SQLs for their sales data, we were having two completely different conversations. Another example is TCV, total contract value. To finance, that's a long-term liability. To sales, they saw that as their ticket to having lunch with the president. And marketing saw this as a metric for turnover ROI. And the biggest revelation came inside Salesforce, digging into that data. We were trying to define a customer. Sounds simple. It wasn't. Marketing, a customer is anyone who downloaded product collateral. Sales, customer sees this as an opportunity with a 70% chance of closing. And to our client account management team, a customer was someone with an active contract. So forcing a single rigid definition would have broken their workflows. But by walking with them, we realized the truth. Context is the most important metadata. We heard that a lot yesterday. We didn't need one definition. We actually needed more of a map showing how a lead matures into an opportunity and eventually becomes a contracted client. And once we learned their acronyms, their Salesforce cycle, their language, something shifted. We stopped being the data people, and we became the people who help us understand our pipeline. So why relevance is the fuel for governance? Context over control. Can't stress this enough. Data without context is noise. When we understand business intent, governance becomes usable and not restrictive. We apply the right guardrails at the right stage of their life cycle. Reducing cognitive load. When our catalogs, definitions, and dashboards uses the business's acronyms, we lower the barrier to entry. People use data more when it sounds like them and not like a textbook. Adoption through value. When stakeholders see that governance helps them distinguish between a sales qualified lead and a database query, they become our advocates in governance. You're not forcing a tool. They see you helping them win deals, hit their targets, and tell clearer stories. So we've got relationships, we've got relevance, lastly, roadmaps. My journey into data governance wasn't linear. In university, I majored in geography. And looking back, it was kind of the perfect preparation for this career. And I've been inspired by the Canadian philosopher Marshall McLuhan, who famously said, "The medium is the message." He also talked about maps of meaning and the idea that in a world of complexity, people need shared maps in order to navigate that chaos. And these maps, they're not just drawings, they're what make coordinated action possible. A lot of talk about change management, coordinated action. So in my role, I asked to see everyone's roadmaps. Product development, IT, risk, the PMO, they're just in spreadsheets. Others look like a high-tech treasure map. My favorite is from the strategy team, clean, simple, honest. And because we built trust, they share their real aspirations and not the sanitized versions. The part that most people miss is this. The magic isn't in the individual maps. The magic is in bringing them together. And data governance is uniquely equipped for that because we live in a world of lineage. We're used to staring at the spaghetti of data flows, and when we overlay everyone's map together, we start to see the intersections, the roadblocks, the detours, and the tangents that nobody else sees. Lately, everybody's roadmap has AI plastered all over it, bold font, flashy animations, lots of buzzwords, but what's almost always missing, or written in tiny gray italics, is the word data. And that's where governance adds value. We remind people that the intelligence in AI is only as strong as the information feeding it. If the data is, can I get an amen? If the data is wrong, incomplete, misaligned, duplicated, inconsistent, misunderstood, AI is not going to fix it. It's going to amplify it. Roadmaps aren't just planning tools. They are the engine of innovation. And there are 3 reasons I'll cover. Creating meaning before movement. Your data governance roadmap shouldn't be a checklist of tasks or a list of tools you want to buy. It should define what data means to the organization, the milestones that build trust, and the moments that spark possibility. So we intentionally avoid putting technologies on our map. Instead, we make the destination clear. Because when people know where they're going, they feel safe enough to innovate. Sorry, one back. Shaping data behavior. When we look at other teams' roadmaps, we're not hunting for deadlines. We look for behavior. We look for points on their journey where they could speed up and accelerate. We look for parts where reuse matters, accountability is there, and ethical data use. That's essential. We just heard it, data governance by design. And so by knowing where these touch points are, we can advise those teams on where they can take the calculated risks, where maybe they need to slow down a little bit to protect the data and earn trust. Shared maps, they enable innovation at scale. When you see that, shared understanding, that's a superpower. When everyone is looking at the same map, you remove the friction and the anxiety of the unknown. And our governance guardrails aren't designed to slow the car down. They're the safety barriers on a racetrack. And they let the organization know where they can redline and rev that engine because everyone knows exactly where the edges of the track are. Okay, I want to leave you today by finishing the story I started earlier, the one about the job interview that didn't go exactly as planned. So I remember sitting there, strange cocktail of feelings, nervous, mixed with probably a lot of overconfidence. I had come prepared with what I thought was a brilliant idea, the soccer ball. To me, it really is the perfect metaphor for metadata management and definitions, and I thought I just blew their minds. So I laid it out there, I went through my analogy, and I delivered that punchline, and then silence. Maybe not the polite kind of silence, not the thoughtful silence. It felt like an eternity, might have been really only 3 or 4 seconds. But finally, the CIO cleared his throat and said, anyways, and moved on to the next question. Now, in that moment, I was crushed. Now, I might add that it was just over a year later, I had lunch with a colleague that worked at that same company, and his colleague recognized me as the idiot with the soccer ball. So I guess I did leave an impression. But looking back, especially in light of all that we've talked about today, I realized exactly why that soccer ball deflated. First, there was no relationship. I was a complete stranger in that room. I hadn't built any connections. I hadn't earned their trust. And without that foundation, they were not ready to buy into my vision, no matter how clever my soccer ball analogy was. No relevance. Sure, the metaphor made sense in my head, but I didn't know their language yet. I hadn't done the work to understand what mattered to them, what frustrated them, what kept them up at night. And because I didn't speak their dialect, my message was just noise. And finally, without trust and without relevance, there's no roadmap. You can't paint a picture of the future if people don't believe you understand where they stand today. So I share that story because I don't want your data governance strategy. Please share that as you will. I don't want it to become a anyways moment. But if you want to be an enabler of innovation, if you want to transform your spaghetti of data into a map of meaning, if you want people to follow you, start with the people. Learn their acronyms, walk alongside them, build shared maps together, because when you speak their language, you earn their trust, and connect your work to what matters to them, that's when the art of the possible becomes a reality. Thank you. I do have a couple minutes to answer any questions, like, did I get the job? No, I did not get the job, of course, but yeah, question in the back.
Hi, thank you. Very interesting presentation. I was wondering, in your experience, when you ask to see the roadmaps of the different groups and you build those relationships, do you ever get resistance from people that look at you as if you're trying to do their job, or what are you talking about? This is not your domain. Leave me alone. Do you ever feel that you can have those reactions from people?
Yes, yes, even though a lot talked about. So one example is privacy. Obviously, because it's privacy, they like to keep things private, et cetera. So there was a little bit of pushback. And interestingly enough, like when we did get to see their roadmap and see what they were looking for, they had on there about upcoming privacy legislation, and they talked about anonymization in there. Curiosity. I started asking a lot of those questions. What does this mean? Like de-identification, et cetera. And once we built that little bit of a bridge that I was there to kind of learn a little bit more, the walls came down. And then we were like, hey, can we help sponsor a data anonymization tool for the enterprise? And they were like, yes. And then all of a sudden, because it was on their roadmap and we were sharing that, our machine learning engineers and AI, they were all like, hey, and all of a sudden they were beginning to. So that was a critical piece. The other part in the company that's usually hard to break through is legal. I love lawyers, but they tend to be very guarded. And again, it was kind of coming back down to, can you help me understand what's in the contract? And because there's definitions in there. We need to know that. And we started building those shared connections. All of a sudden, of course, our marketing team was big on that. And that connection, it just needs a couple, but eventually they begin to say, hey, what's going on over there? Data governance isn't the enemy, they're our friend. Good question. Alors, déjeuner pour? Oh, was a question, sorry.
I got a small question. I was wondering, who is your point of entry that you talk to? Because there's a lot of people that want to get engaged with the data, but do you go right away the highest in the hierarchy you can go, or you talk really to subject matter expert, for example?
A couple tips that I have is that I pay attention to, you know, those employee welcome to the company things? I'm right there. I'm like, hi, I'm from data governance, let me introduce myself. So that's always, and it doesn't matter who, doesn't matter what level. The ground is level when it comes to data, right? There's none of this hierarchy piece of it. So it really comes to anybody. And the other part of it is, it is hard to kind of break through that kind of senior executive level. I find it's, I think we talked about it before, it's like all they want is a number or a specific, none of this other stuff. So that tends to be a little bit harder to get through. But what I have found is that no matter where I go, if it's front line, first or second line, they start to say, hey, you know, Jill from the data governance team, I don't know what they're doing there, but it's kind of cool. You want to talk to, and all of a sudden that gets around there, you get momentum, exactly, and it spreads out organically. So start anywhere, that's what I would say, but start like now. Okay? Thank you.
There is a question.
I can't see the pillar. Okay.
Thanks. I'm going to ask a very hard and maybe practical questions. So in the reality, I know you talk about how important the trust is between business and data governance people, but in the real world, often the two parties hate each other because data governance often asked business to do some actual work while the business treated as just admin job and saying, hey, we're doing perfectly fine, but the truth is they aren't. So when the situation where the trust is already broken, what is your advice for things like that?
Hugs. Lots and lots of hugs. I'm just kidding there. So my advice is humility. And it is tough when I'm like they see me as a senior leader, as a manager, et cetera. But humility goes a long way. And I might tell them the soccer ball story just to kind of say, you know what, I've made mistakes as well, and but I've learned from them. When I've kind of found that piece of it really breaks down. It's a lot of, my best friend's a therapist, and I've known him since kindergarten, and he has said a lot about what it means to like your body language and like all these little things. You think, okay, should we talk about technicalities? But that really goes a long way just to inject a little bit of humility. And rebuild those relationships. Once you build those connections, you'll find that the second part, which is relevance, and you'll kind of find out a little bit more about what's an angle, what's a way that I can get in there to be able to make some corrective actions there. So hopefully that helps. Thank you.
All right. Well, thank you. Don't go yet. Don't go yet, Raymond. Thank you. So first of all, A+ in storytelling. I want to tell you that. It was very interesting. You look like a wonderful person to work with. Also, we've been seeing the whole, yesterday, today, a lot of centricity on people. You also show that, trust people. But I also wanted to tell you something. I think the soccer ball was brilliant.
I didn't come up with it. I saw it at a conference one day, and then it was great.
Yeah, and I think not just a story for today, but I think that maybe also sometimes it's the audience, right? Maybe what the whole story takes you is that's not the right people you should be working with. I think that, like that attitude they had towards something very creative, it was maybe the wrong attitude. And I think like I would have been like, oh yeah, like this is like a very good way to expose something which is storytelling, and anybody beyond the data environment will understand this in the business. This person can communicate with the business, which in data governance is the bread and butter
That's right.
of the job. So yeah, I don't think that you should feel like you did wrong. I think that you should feel that you did it with the wrong people, which is different.
Good call.
So I think it was a very good way to break the ice. Just like I said,
Thank you.
not
Appreciate
with the right people, but good that you're not working with them. Probably you have better bosses now. So thank you.
Thank you.
Nice to meet you. Now is after lunch. There is 2 tracks still? Okay. So now it is the moment everybody was waiting for the day, which is the lunchtime. So food is ready. You guys probably hungry. Go for lunch, and then at 2:10, we're gonna be back to whoever hasn't filled out the survey to fill out the survey, which is very important. I hope that after my reminder this morning, we got more people that have filled it out. And then at 2:15, we have a panel discussion. But we're breaking into track 1 and track 2. So that's what you were telling me, because.
Yeah, so Austin ended up coming back, arriving. So at 2:15, in track 1 is going to be Letty's session, and then Austin is going to do this.
Okay. So then it will be track 1 and track 2 at 2:15. So yes.
And I've updated Brella. So.
You updated the app. So as I always say, the app is updated. So bon appetit, everybody.